What's up guys, Tim Layton here. Welcome back to my YouTube channel. Today is going to be a little bit different than my previous videos where I do my option strategy update. Too many of you people have been telling me that you don't understand my videos because you don't understand anything about the stock market. So what I'm saying is kind of gibberish to you. Well, all that ends today because today is how to invest in the stock market. I'm going to be going over all of the basics in the stock market. If you already know a little bit about the market, then this video might not be for you. But if you're just getting started, this video is going to be perfect. With that being said, let's get right into this. Alright guys, so what is the stock market? What is it? Well, the stock market is where investors connect to buy and sell investments, most commonly stocks, which are shares of ownership in a public company. So what are investors? Investors are me and you, and then people also way bigger than us. We're all investors. People like hedge funds, billionaires, Nancy Pelosi. And what are shares of ownership in a public company? Shares of ownership are most commonly called stock. Each stock, you're buying a piece of the company. It sounds crazy, but when you buy a stock, you are a part owner of that company. Now that part ownership might be 0.0000001%, but you own part of that company. And because you own part of that company, you get to reap the rewards when that company does well. When they earn money, you earn money. And then inversely, when they lose money, you also lose money. So should you invest in the stock market? Maybe that's a question going around in your head. Yes, definitely 100% unequivocally, you should invest in the stock market, without a doubt. But the question really becomes, how should you invest in the stock market? So we need to break down all the different types of investments in the stock market. And what we're going to start off with is ETFs, exchange traded funds. So what an exchange traded fund is, it is a type of security that tracks an index, sector, or commodity or other asset, but which can be purchased or sold on a stock exchange the same way a stock can. ETFs can contain many types of investment, including stocks, commodities, bonds, or a mixture of different investment types. Alright, so let's break down exchange traded fund. What is that? Sounds complicated. There's a lot to unpack. So it's a fund that holds multiple assets and it's traded on an exchange exactly like an individual stock is. So it's super easy to access. And it tracks a commodity such as oil and natural gas, metals like gold, silver, steel, agriculture, and even corn. It gets as specific as an individual thing like corn. If you really thought corn was going to the moon, you can get an ETF that tracks the price of corn. And that's really cool because you don't have to load up corn in your garage to make money off of it. You can just buy this ETF that tracks corn and you can profit if, for whatever reason, corn rises in value. So it also tracks things like indexes. Indexes like the S&P 500 and the NASDAQ, the little things you see on the news at the bottom of the screen that says if they're up or down for the day. So by investing in things like SPY, ticker symbol SPY, you can reap the gains from 500 stocks while only putting money into this one stock, into this one ETF. So aside from tracking commodities and indexes, it can also track different sectors or industries. And that's a great way to diversify into something that you really believe is going to take off. For instance, electric vehicles, EVs, I believe in. I think they're taking over the world. But I don't know exactly which companies are going to benefit the most in the next 10 years. So what I can do is I can search up electric vehicle ETF and I can invest in something like ticker symbol DRIV, DRIV. I can invest into the whole EV self-driving market and actually see what I am invested in. It shows the top 10 holdings of this ETF right here. These are all of the stocks. These are the top 10 stocks inside of this ETF. Alright, so to wrap it up all nice and neat for you for ETFs, they are a very easy way into the stock market. And they're also a very smart investment because of their diversity. You can buy into hundreds of different stocks without having to buy hundreds of different stocks. You buy this one ETF and you're set. And they protect you from the volatility of individual stocks. For instance, again, if I really like EVs and Tesla plummets one day 10%, I don't lose 10%. Because in this ticker symbol DRIV, Tesla was only a small percentage of this ETF. Which means if Tesla plummets because Elon Musk does something stupid, I don't get hurt too much by that. I may be down 0.5%. All right, so ETFs lead to generally smaller losses during bad times, like I just said, if Elon Musk does something stupid, but then they can also potentially lead to smaller gains during positive times. If Elon Musk just came out with something revolutionary that was going to change the world, and Tesla shoots up 100%, you're not going to see a 100% gain. You'll maybe see a 10, 15% gain because of all the different stocks inside of that ETF. Tesla only makes up a small percentage of it. So if it shoots up 100%, you're not shooting up a whole 100%. So it is a positive and a negative at the same time. All right, next up on the list of things you need to know are bonds. So I'm not going to get too deep into this because they're pretty straightforward, pretty simple, and they're also a little boring to me. But I'm still going to tell you exactly what they are because you need to know what they are. Just because I think they're boring doesn't mean you will. I want you to make an informed decision based off of the information that I give you. So with that said, let's get into it. What is a bond? In simple terms, it's a loan from an investor to a borrower, such as a company or a government. The borrower uses the money to fund its operations, and the investor receives interest on the investment. The market value of a bond can change over time. So the best way I can kind of break this down is think of yourself as a bank. If you want to buy a new car, you go into the bank and you borrow some money with the agreement that you pay them back within the specified amount of time in the loan and with interest paid over that time period. So that's exactly what a bond is, except this time you get to be the bank. That's actually what's happening. You are the bank. You give the government money and they say, I'm going to borrow this money for 3 months, for 10 years, for 20 years, and I'm going to pay you this amount of interest every year. And then at the end of this term, 5 years, 10 years, whatever, 30 years, you get all of your money back. So for government bonds, the amount of interest you get annually depends on the amount of time you agree to lend them money. They want your money, so the longer you agree to loan them that money, the more interest they're going to pay you. You can see here that interest climbs as the length of time extends. The downside to bonds is that the 30-year bond, the longest bond available, only returns 3.82% annually. For comparison, the S&P 500, one of these stock market indexes, has averaged 10.72% over the last 32 years. So that's the price you pay for the safety of a bond. You lose some money, but you get guaranteed money. Even if it's only 3.82% annually, it is guaranteed. The S&P 500 can crash at any time and you can lose all your money. All right, so back to that last sentence of the definition that I said values of bonds change over time. Values of bonds do change, but that is irrelevant to you unless you want to sell the bond early. As long as you hold the bond for the specified amount of time, again, 3 months, 6 months, 1 year, 2 years, 10 years, 30 years, you will get your exact money back, plus the interest that you've earned over that time period. But if you want to sell it early, it will be at its current value, and those do change. So that'd be the penalty to selling your bond early. All right, last but not least, we have individual stocks. Maybe you want to trade on your own. Maybe you think you can do better than the S&P 500. 10% a year isn't that much. Maybe you could do better. Just for reference though, 92% of people who actively trade cannot beat the S&P 500, but it doesn't hurt to try. So here's a list of different types of stocks that can make you money in different ways. So first on the list, we have dividend stocks. A dividend is a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits. The amount of money you get paid in a dividend stock is shown by what's called a dividend yield. And a dividend yield is the percentage they pay you annually based on the stock price. Exxon is a good example. I own some. They pay a pretty fair dividend. I would say between 4 to 5% is a good amount for a dividend stock. In small amounts, you don't really notice dividends, but let's just do some math here. If you had, let's say, $500,000 in Exxon at their 4.86 dividend yield, that would pay you $24,000 annually. That's a good amount. But as I said, if you only have a couple $100 in Exxon, you're not really going to notice their dividend. I think I have $1,500 in, and they pay me, I think it's like $12 a quarter, so it's not much, but it's better than nothing. So a growth stock is a company that is anticipated to grow at a rate significantly above the average growth for the market. An easy way to identify them is through their PE ratio. They typically have a high PE ratio. PE ratio is price to earning ratio, the price of a company stock versus the amount of money they earn. The average PE ratio for the S&P 500 is 15. Growth stocks usually have a pretty high PE ratio because a lot of people anticipate them to earn a lot more money in the future. Some examples of growth stocks are FB, Facebook, or Meta now, with a modest PE ratio of 23, Tesla with an absurd PE ratio of 339, and then we got Amazon with a relatively high PE ratio of 63. So people expect these companies to do very well in the future. So, since they expect the company to do well, the price as well as the PE ratio keeps rising in anticipation of them being such a good company. Alright, so next up we got value stocks. A value stock is a security or a stock trading at a lower price than what the company's performance may otherwise indicate. Good examples of value stocks are banks. You can identify these stocks by their low PE ratio. Some examples here, we got Goldman Sachs, for instance, has a PE ratio of 6. Remember, the market average is 15, meaning their price is a lot lower than it reasonably should be with the money that they earn. Other examples are Verizon with a PE ratio of 10 and FedEx with a PE ratio of 14. These stocks are undervalued, so people buy them because they should be rising in price to the fair value. Again, PE ratio of 15 is average. And now finally, you have blue chip stocks. A blue chip stock is a stock that has a large market cap, a sterling reputation, and many years of success, meaning you can pretty comfortably put your money there and you know that company's not going anywhere. Some examples of these types of companies are Coca-Cola, 3M, Johnson & Johnson, JP Morgan, Visa. These companies have been around for years and have been making money consistently for pretty much ever. Alright guys, before you jump right into the stock market, it's very important that before you invest, you think long and hard about your risk tolerance. That means how much money you're willing to invest and how much money you're willing to lose. Because it is possible that you lose money in the stock market. It happens to everybody. And you also need to take into account how badly you want to make that money and align the stocks that you buy with the risk level that you've assigned yourself. Index ETFs like the SPY, they're safe, they're low risk, have pretty consistent returns over long periods of time. Blue chip stocks and value stocks are pretty safe, they're medium to low risk. You still have the risk of the CEO doing something stupid and you losing money, but they are pretty low risk, they're pretty consistent gains. And then you have growth stocks. Those are a higher risk because they're not currently making the money that people anticipate they should be. So if something happens where they don't start turning that profit that people think, they will drop down to a fair value. And for Tesla, for instance, with a price to earning ratio of 339, if it drops to a fair market value, a PE ratio of 15, you guys are losing a lot of money. And that's something you have to consider. And then finally, you have options trading, which is very high risk. Now, I'm going to get into that in future videos. This is just a little video to get you guys a taste of the market. Options trading is going to be, I think, a 3-part video in the future. And finally, you have penny stocks, which I'm not even going to get into because I've lost some good money in penny stocks. Most people do. These are stocks that trade near a penny. They're tiny companies just beginning. And in case you guys don't know, a lot of companies don't make it past the first few years. They don't turn into these billion-dollar companies. So it is a very, very high risk, and you will probably lose a decent amount of money. Now, if you don't have a trading app already, I do highly recommend Robinhood. There has been a lot of controversy around them about their ethics, but they are a very simple, very easy to use trading app. And there's no fees, so you can really get the hang of buying and selling stocks with no downside. You don't have to pay to do it, and it's really nice. I have a link in the description to sign you up for Robinhood. If you use that link, you get a free stock, and I also get a free stock. You don't have to help me out, but I'd really appreciate it if you did. So I think that's going to do it for this video. I will be going into options trading. Like I said, that will be a 3-part series here in the next few days, maybe next week. And then I'll also be going into cryptocurrency. That's probably going to be at least a week or two away. This one was specifically for the stock market basics. I know I didn't get into too much stuff, but I just wanted to give you guys a taste of the stock market so you know what you're looking for.